Geopolitical risk models generally operate on a simple assumption. Physical proximity to a military threat mandates a high-risk premium. The closer the guns, the lower the asset valuations. Looking at the Taiwan Strait from 2020 to 2024, the military pressure escalated exactly as those models fear. The People's Liberation Army recorded roughly 380 incursions into Taiwan's air defense identification zone in 2020. By 2022, that number surged past 1,700, establishing a continuous, high-pressure baseline that remained steady through 2024. This chart plots the rising area of ADIZ incursion counts against the Taiwan Stock Exchange Index. While standard models predict an inverse relationship, the data shows the historical correlation breaks here. As flight counts multiplied, the market reached new highs, breaking past 23,000 points. There was a notable contraction in 2022. Following a high-profile U.S. political visit in August and the subsequent military encirclement drills, the index experienced a sharp, localized drop. However, examining the macroeconomic data reveals that the 2022 bear market aligned precisely with the Federal Reserve's aggressive interest rate hike cycle and the resulting global capital contraction, rather than regional military friction. The true stress test arrived in 2023. ADIZ flights remained historically high at over 1,700 inversions. In that exact same window, the index rebounded by more than 40%. Empirical market data indicates a significant shift in how regional risks are priced. The Taiwan stock market has decoupled from regional military pressure. In April 2025, a peer-reviewed empirical study published in Science Direct tested this precise divergence to see if the correlation was truly absent. Researchers modeled daily flight impacts across 4 market levels: overall TAIEX, ETFs, individual stocks, and sectors. They tested this against 5 statistical variables, from daily counts to major exercises. Across every layer and variable, they found 0 statistically significant correlation between flights and stock returns. Even after controlling for fixed effects like yearly anomalies, monthly cycles, and daily trading fluctuations, the result held steady. The incursions provided no explanatory power for market behavior. The quantitative evidence is definitive. Taiwan's stock market possesses a measurable structural immunity to gray zone military operations. To understand why a financial ecosystem ignores fighter jets, we first have to look at the behavioral finance concept of habituation, also known as the desensitization effect. Humans and trading algorithms both exhibit loss aversion, reacting sharply to sudden threats. But when a stress stimulus repeats daily without causing physical destruction, the psychological reaction diminishes. The risk premium recalibrates to a new baseline. A 2023 empirical survey noted that 77% of the public emotional impact regarding the flights was indirectly mediated through media reports rather than direct physical experience. Institutional capital allocators use models calibrated to filter out that media amplification. When there is no physical disruption, daily incursions are categorized as baseline background noise. This mechanism dictates the market's specific reactions. Rare, high-profile political shock events introduce unknown variables and trigger brief volatility, but the daily flight counts that follow are processed as a known, non-destructive quantity. Financial markets operate on probability and physical outcomes. They do not maintain a high-risk premium for a recurring event that yields no material damage. While the geopolitical noise diminishes, the market is simultaneously pulled upward by a separate force: the macro-financial gravity of the global semiconductor supply chain. The Taiwan Stock Exchange is structurally top-heavy. The Taiwan Semiconductor Manufacturing Company alone accounts for nearly 40% of the entire market capitalization. That specific valuation is tightly bound to global tech demand, holding an exceptionally high 0.96 Thiessen correlation coefficient with NVIDIA's stock performance. The global capital required to build out AI infrastructure generates its own immense gravitational pull. For investors, the potential returns from this technological cycle outweigh the marginal data provided by military flight counts. Institutional capital allocators strictly track earnings per share and projected cash flows. In their models, these physical and financial metrics are the primary drivers of value. This dynamic was demonstrated during the Justice Mission encirclement drills in late 2025. Instead of a sell-off, surging earnings reports from the AI supply chain pushed the index to historical highs while naval vessels sat offshore. The technological revolution in computational power currently acts as the primary anchor for market pricing, reducing regional military metrics to secondary variables. From a sociological standpoint, publishing daily flight counts is a textbook Foucauldian spectacle of power. It is a form of cognitive warfare designed to discipline the observer and instill persistent anxiety. Institutional capital, however, prioritizes material data over narrative. Because it is optimized to track physical production and logistics, it is largely insulated from the psychological effects of gray zone signaling. Investment in Taiwan relies on the underlying calculus of mutually assured economic destruction. The market measures a strict physical reality. It asks only two questions: is the logistics infrastructure open, and are the extreme ultraviolet lithography machines physically operating? This is the logic of the silicon shield. Because kinetic destruction of Taiwan's semiconductor capacity would immediately damage the aggressor's own economy, risk models significantly discount the statistical probability of total war. Financial risk models distinguish between performative gray zone friction, which they ignore, and actual kinetic invasion preparations, which would trigger an immediate repricing of assets. The cognitive warfare campaign has failed to impact the financial ecosystem because current institutional risk models are calibrated to physical disruption, not symbolic friction. There is a vital distinction here. The market's documented immunity to gray zone operations does not equal immunity to actual kinetic conflict. The true systemic risk to Taiwan's valuation isn't the daily air traffic. It is the possibility of global supply chains successfully bypassing the island's manufacturing dominance, an event that would weaken the logic of the silicon shield. For institutional investors, the data is clear. Daily A discounts and geopolitical noise are no longer reliable triggers for portfolio rebalancing. Long-term strategy relies on tracking forces that actually move the market: Fed policy rates and global AI capital expenditure cycles. Taiwan's long-term valuation is tied strictly to these structural forces, specifically global AI compute demand and inflation's macroeconomic impact, rather than regional military flights. Navigating this environment requires analytical discipline. It requires looking past the spectacle of military noise and remaining anchored to the macroeconomic fundamentals that drive value.